Welcome back to the Gold Standard. A lot has happened in precious metals this week, and Marcus Blackwell, I think listeners are going to want to stay through every segment today.
Agreed, Sasha Reyes. This episode covers the full picture, from central bank strategy shifting in real time to some striking calls on where silver prices could go.
Here's where we start. France quietly pocketed around $15 billion by moving its U.S. gold reserves back to European storage. Meanwhile, Bloomberg reports Tether now holds nearly $20 billion in gold, making it the largest known non-bank, non-government holder on the planet.
And central banks in China and Turkey are still buying. The New York Times had a piece this week on why countries are stocking up. And the short answer is risk is rising and gold is being reclassified as a reserve asset.
Then the price story. Gold just posted its biggest two-month drop on record. The Fed held rates and flagged inflation risk in the same breath, which pushed near-term sellers into action. We'll dig into what analysts think that means for timing.
And silver. Investing.com put the cumulative supply deficit at 762 million ounces. Bank of America has floated a $309 year-end target as an upper bound scenario. We'll walk through what would actually need to happen for that to play out.
Finally, on the mining side, Wheaton closed its record BHP streaming deal, Barrick is spinning off its North American assets to New York, and gold miners broadly still look undervalued relative to spot. Plenty to work through.
Let's get into it. First up, the global reserve shift.
Here's a story that cuts against everything you think you know about the gold market right now. While China, Turkey, and half the world's central banks are loading up on bullion, France went in the opposite direction. France sold its U.S.-held gold reserves, pocketed a reported $15 billion profit, and then quietly repurchased the same gold, storing it in Europe instead.
So France didn't exit gold. France relocated gold.
Exactly. And that distinction matters. This wasn't a bet against gold. It was a bet against holding it on American soil.
Cementing that was not a bet against gold, it was a bet against holding it on American soil.
Right. And it's not an isolated move. According to the New York Times this week, central bank gold buying has been accelerating globally as countries look to reduce dollar dependency. The IMF has started acknowledging gold's strengthening role in sovereign reserves.
Which brings us to the bigger structural story. Bloomberg published a piece Thursday arguing that gold is returning to pre-1990s reserve levels. We're talking about gold's share of global reserves climbing back toward territory last seen before Bretton Woods collapsed.
To put this in perspective, that's not a short-term trade. That's a multi-decade reset of how the world stores wealth.
And it's not just sovereign actors doing the buying. Bloomberg reported Friday that Tether, the stablecoin issuer, bought more than 6 tons of gold in the first quarter alone. Their total gold hoard is approaching $20 billion.
A crypto company holding more gold than most nation-states.
Larger than most central banks, yes. And they're the largest known non-sovereign gold holder in the world.
Here's why this matters. For decades, reserve building was a sovereign story. Central banks, the IMF, national treasuries. Now, a private stablecoin issuer is using gold the same way countries do, as a hard asset anchor for their balance sheet.
Stevenson at SD Bullion published an analysis today pointing out that central bank buying is pushing gold back toward 40% of global reserves. If that trend holds, we're looking at structural demand that doesn't respond to interest rate cycles the way retail demand does.
Which is a point worth holding on to, because the price hasn't been reflecting that story recently.
No, it hasn't. Gold had some turbulence after the Fed held rates Wednesday. Bloomberg noted it held a 3-day loss following that decision, with the Fed also flagging ongoing inflation risk from the Iran situation.
And Indexbox noted that analysts are still forecasting gold above $6,000 an ounce. So you've got near-term price softness sitting right next to long-term structural buying from sovereigns, institutions, and now crypto treasuries.
Turkey monetized 108 tons of gold in March, according to the Indexbox piece. China added 5 tons. These aren't small positions.
So we have France repositioning, China accumulating, Turkey mobilizing reserves, and Tether stacking tons in Q1. The direction of the structural trade is pretty clear.
The question is timing, and that's where the price action gets genuinely interesting because the near-term chart and the long-term thesis are pointing in different directions right now.
Exactly. And if the reserve accumulation story is this strong, why has gold just posted one of its sharpest pullbacks in recent memory? What does the price actually tell us versus what the structural flows are signaling? So here's where the short-term picture gets jarring. MarketWatch reported this week that gold just posted its biggest two-month drop on record. After everything we described in the last segment, the structural buying, the central bank accumulation, the price action is telling a completely different story.
The tension is exactly what investors need to sit with. The record drop is real, but the question worth asking is whether a price correction in the middle of a structural bull market is noise or signal.
What's driving the pullback?
The Fed, mainly. Bloomberg reported Wednesday that the central bank held rates again and simultaneously flagged inflation risks. That combination left gold in a holding pattern. Traders who were pricing in rate cuts this summer got no relief.
Right. And when rate cuts get pushed out, the opportunity cost of holding gold goes up. So you see selling even when the long-term case hasn't changed.
Exactly. The Economic Times had analysts offering mixed views on near-term direction after that Fed decision. No consensus on the next move.
So where does that leave someone watching from the sidelines? Is there a window forming?
A.G. Thorson over at FX Empire flagged July as the next likely entry point. The view is that gold and silver are in a consolidation phase after explosive gains in 2025. A breather before the next leg.
That matches what Kidco was framing this week. Short-term weakness sitting on top of a longer-term bull structure. The two aren't mutually exclusive.
To put this in perspective, MarketWatch also noted that even after this drop, some analyst forecasts have gold doubling from here within 5 years. A 2-month correction doesn't erase that thesis.
And the consolidation case actually gets stronger when you zoom out. If central banks are still accumulating, if gold is returning to 40% of global reserves, as Bloomberg's reserve data shows, a price pullback is a reloading moment, not a reversal.
Here's why this matters for framing the rest of our conversation today. The gold pullback looks like a macro reaction to Fed policy. Reasonable, explainable. But silver's pullback is a different animal.
How so?
Silver dropped in tandem with gold, which is normal. The two move together on macro signals. But gold's correction is happening against a backdrop of solid above-ground supply. Silver's correction is happening against something that contradicts it almost entirely.
You're talking about the physical market.
Exactly. The spot price is telling one story, the supply data underneath it is telling another, and the gap between those two readings is getting hard to ignore.
So the price weakness looks like an opportunity in gold, but in silver, it might actually be masking something more serious, a structural problem that the futures market hasn't fully priced in.
That's the right framing, and the numbers on the physical side of silver are striking enough that they deserve their own conversation.
The deficit figures is where this goes from interesting to genuinely significant. We'll get into exactly how large that gap has become and what it means for where silver goes from here.
$762 million ounces. That's the cumulative silver deficit confirmed by investing.com this week, and above-ground stocks are actually being drawn down. We're past the warning stage.
That number stops me every time. To put this in perspective, that's not a one-year shortfall. That's years of demand outstripping supply stacking up.
And the key question is always, why can't mining supply just respond? Here's why this matters. Silver is primarily a byproduct. About 70% of silver comes from mines targeting copper, zinc, or lead.
Right.
Miners aren't sinking shafts for silver. They're following base metals.
So when silver prices rise, the incentive signal goes mostly nowhere.
Largely nowhere. Add permitting backlogs running years in some jurisdictions, falling ore grades across established deposits, and you've got supply that structurally cannot react fast to a price move. The physical tightening just compounds quietly.
Broker.com had a piece on this Friday describing it as a silent supply crisis. Physical market tightening steadily beneath the surface while futures prices mask the stress.
And investing.com's data makes it explicit. Stocks confirmed reduced. That phrase matters. Reduced stocks means someone is actually giving up metal to cover demand. The buffer is shrinking.
Toe flips that against Bank of America's call. They put a $30.90 target on silver by end of 2026. Bar chart covered the mechanics this week. Their argument rests on the gold-to-silver ratio snapping back toward rare historical levels.
Walk through that ratio quickly.
Right now, gold trades at roughly 100 times the price of silver. Historically, the ratio has compressed to 30 or 40 to 1 during peak cycles. Bank of America's $309 scenario assumes that compression happens while gold holds elevated. Industrial demand keeps growing, safe haven demand layers on top, and supply can't respond. That's the combination they need.
And Advisor Perspectives flagged something important about that call. The $309 figure is explicitly an upper bound scenario, not their central forecast. The mechanism requires tight supply, plus surging industrial demand, plus safe haven flows all arriving together.
Which is actually possible given the deficit data. Not guaranteed, but the structural pieces are in place. Silver's industrial demand from solar panels and electronics keep compounding. SD Bullion published a piece today noting the supply-demand imbalance is building momentum toward a silver repricing.
The important thing to understand is that this isn't a trade thesis waiting for a catalyst. The deficit is already confirmed. The stocks are already falling. The question for investors is when the futures market prices what the physical market already knows.
And that gap between physical reality and paper price is exactly where the opportunity sits. Whether that closes at $50, $100, or $309 is the range of outcomes, not a single answer.
Which brings us to how institutional money is already moving around this. Because while silver's structural story builds, the royalty and streaming companies are locking in positions now. Wheaton Precious Metals just closed its largest streaming deal ever with BHP. We'll get into that next. The short pause.
So Wheaton Precious Metals just closed its largest streaming deal ever, and Marcus Blackwell, this one is worth slowing down on.
The BHP deal. Streaming at scale. What's the structure tell you?
A lot. Wheaton partnered with BHP on the Jervois project in Australia, and on the same week they added a royalty agreement with Spanish Mountain Gold. According to Yahoo Finance and Simply Wall Street, that follows their record Antamina streaming transaction. This company is stacking exposure fast.
Here's why this matters for listeners who don't want direct commodity risk. A streaming deal means Wheaton puts capital in upfront, then buys production at a fixed low price. They don't operate mines. They don't carry the same cost inflation risk that traditional miners do.
Right, so when gold or silver prices rise, their margins expand without them having to dig an extra ounce. The leverage is built in.
And the BHP connection matters. BHP is not a marginal operation. That's institutional-grade counterparty risk. Wheaton isn't speculating. They're locking in supply from proven assets.
Now connect that to Barrick. Bloomberg reported that Barrick Mining plans to list its North American operations separately in New York, targeting completion by the end of this year.
A spin-off of the North American assets specifically. That's a capital allocation story. They're essentially saying investors in different regions want different risk profiles, and we're going to let the market price that.
Which is smart, honestly. A New York-listed vehicle gets access to a different institutional base. Pension funds, index trackers, U.S. retail. The gold miner universe becomes easier to own in pieces.
And that matters because of where miner valuations sit right now. Seeking Alpha's analysis on the Sprott Active Gold and Silver Miners ETF made this point clearly. Gold miners broadly remain undervalued relative to the spot price. The gap between what gold is doing and what mining equities have done is still wide.
Think about it this way. Gold has run hard over the past 18 months, but many miners haven't kept pace. That gap is either a valuation opportunity or a signal that the market sees margin pressure ahead.
Market Beat flagged Newmont, Agnico Eagle, and Barrick among names worth watching right now. The question for any individual investor is, do you want the leverage of miners, the steady income profile of a royalty company like Wheaton, or just the metal itself?
And the answer depends on your time horizon and your risk tolerance. Royalty companies smooth the ride. Miners amplify it. Physical metal anchors it.
What we're watching across all three of these stories is the same thing. Institutional money has already drawn its conclusions. Wheaton is locking in supply. Barrick is restructuring for access. And the valuation gap in miners is sitting there, visible to anyone paying attention.
The question isn't whether the opportunity is there. The question is whether the conditions that close that gap arrive on your schedule or someone else's.
That's the right frame. Know what you own and why. The structural case is intact. That's a wrap on today's episode, and what a week to be paying attention to metals.
The central bank repositioning story really stuck with me. France booking a $15 billion profit by moving gold off American soil and then buying it back in Europe. That's not a financial trade, that's a geopolitical statement.
And when you layer Tether's $20 billion gold hoard on top of that, a crypto company holding more gold than most nation-states, you realize the definition of who holds reserves is shifting.
The short-term price chart and the long-term thesis are genuinely pulling in opposite directions right now. That tension is the whole story.
Sit with that. If this episode made you think, subscribe and leave us a review. It genuinely helps the show reach more people.
Questions or feedback? Reach us at goldstandard@heymato.com. We read everything.
Thanks for being here. I'm Marcus Blackwell.
And I'm Sasha Reyes. Stay sharp out there.